For those retiring prior to 65, healthcare may be one of your biggest concerns. And it's easy to see why, when it's not out of the question to see a retired couple spend more than $2,000 per month on healthcare alone. Well, in this video today, I'm going to talk about 3 healthcare options you have prior to 65, prior to Medicare, and talk about how choosing the right plan can translate to massive healthcare savings. Let's get into it. Now, the simplest option that retirees have is COBRA insurance. But keep in mind, even though it's the simplest option, that doesn't mean it's the most affordable option. Now, COBRA is continuation insurance. What this means is that you can keep the same plan you just had while you were working, and you can carry that into retirement for a specific period of time. Now, legally speaking, if your company is of a certain size, they legally have to offer COBRA insurance for up to 18 months. They can extend this, however, beyond 18 months. And typically, this is going to be unsubsidized insurance by your employer. So while you were working, your employer probably subsidized your insurance to an extent. Well, now it's unsubsidized here in retirement, and because of that, it can be quite expensive. And so this type of insurance is ideal for those that just really want a simple option or are bridging a very small gap. Again, it can be quite expensive, but if you only have, let's say, 4 months until you're 65, this can be a fine option and will allow you to keep the same coverage you just previously had. Now, the second option we're going to talk about is one that you might not be familiar with. And this is something called health sharing. Now, health sharing, if you find the right program, can have some massive benefits, but keep in mind it can also have some pretty big drawbacks as well. Now, all health sharing is, it's a pooled reimbursement system. What this means is that you and a pool of other retirees essentially are in a health program together. You contribute things like premiums to this pooled system. And then when you have a health issue, you go into your doctor, whatever costs you incur, you pay out of pocket, and then you go back to that pooled system and you are reimbursed for those given costs. Because you are paying those costs out of pocket and not out of insurance, you generally get a discount. This, in terms of the entire pooled system, helps keep costs lower and thus pass those savings on to the health sharing recipients. Now, generally, you need to be relatively healthy to qualify for these health sharing programs. If you have a pre-existing condition, that will disqualify you in most cases. But the big benefit here with health sharing programs is twofold. First, income doesn't affect your premiums. Whether you show $50,000 worth of income or $500,000 worth of income in retirement, you pay the exact same premiums. And these premiums tend to be quite low, all things considered. They typically range anywhere from $100 per month to $500 per month. But understand there are some downsides. Health sharing in general isn't quite as regulated as the normal insurance industry, and because of that, that carries certain risks. I have heard stories of retirees going with the wrong organization. Then when they incur a healthcare cost that wasn't a planned healthcare cost, such as cancer or something like that, they get kicked from the pool. That being said, understand that that type of situation is out of the norm. There are a lot of great upstanding health sharing programs. And so again, the important thing here is do your research, work with a trusted health agent to find if health sharing is a potential option for your retirement. The last option we'll talk about is Affordable Care Act insurance. And we'll spend the most time talking about this option because we tend to see it's the most popular option for those pre-65, but it also tends to be the most complex. And the reason for this is the costs that you pay on Affordable Care Act insurance are directly tied to the income that you show. And so right off the bat, we can see that you can control the costs that you pay by controlling the income that you show. Now the key here is we want to artificially show a lower income to the government, but we want to allow you to take the income you actually want. So you're able to spend how you choose in retirement and not have to live like a pauper early in retirement. Now understand that with Affordable Care Act insurance, there are 4 levels of healthcare plans, everything from bronze to platinum. And really the type of plan simply describes the amount that the insurance company will pay if you incur healthcare costs and then how much you will pay. So basically a bronze plan will have the biggest cost sharing between you and the insurance company, but will have the lowest starting premiums. On the flip side, a platinum plan will be that so-called Cadillac plan, where the insurance company will pay the majority of costs, but you will have a higher monthly healthcare premium as a trade-off. Now, the income number that ACA focuses on is different than any other within the tax code. For this reason, I'll just simply classify this as reported income. But the reason this is different than any other number within the tax code is because it adds back in your untaxed Social Security benefits. So whether it's taxed or untaxed, every dollar of Social Security benefits you will receive will be counted dollar for dollar against you. Outside of this, most other income that you have will be counted in the same way it would in any other tax number. So any wages or IRA distributions that you have will count against you, pension and annuity income will count against you, capital gains, and so on. Now, the massive benefit with ACA insurance is that if you show a low enough income, you can pay $0 per month as a monthly premium because you earn such a large subsidy. Now, you can have the same exact plan as someone who's paying $2,000 per month for that health insurance. Now, not to complicate things further, but understand that there are two ACA regimes that we need to be thinking about depending on when you need this healthcare insurance and when you're retired. From 2023 to 2025, we're under what's called a subsidy cliff. This is a much more forgiving system that was put into law first by the American Rescue Plan and then extended by the Inflation Reduction Act. And what this does is that it extends out a subsidy where you can show a lot higher income and still earn a subsidy. Now, 2025 and beyond, we are going back to the subsidy cliff. Now, this is quite a bit different because it ends up turning into a tax cliff similar to how Medicare's IRMA is set up, meaning that if you show a few dollars more than the subsidy cliff threshold, you will completely lose a subsidy. And that might translate to a $500 per month subsidy gone just like that. Now, each of the breakpoints for when that subsidy phases out, as well as the subsidy cliff, are all set around something called the federal poverty level. And it's essentially a percentage of the federal poverty level. So the subsidy cliff historically has been set at 400% of the federal poverty level. Now, for a single retiree, what this means is once you show over around $54,000 of reported income, you will pass through that subsidy cliff. But let's set aside the subsidy cliff for just 1 second here, because after all, right now we're planning underneath the subsidy slope. And so if you're looking for healthcare options right now, this is the system you need to plan and optimize under. Well, essentially what happens under the subsidy slope is as you start to show a higher amount of income, your subsidy phases out linearly. Now let's quick go through a few scenarios to just show what the landscape looks like right now. Now, the case study we're going to be using is a couple based out of Florida. Now, both retirees within this couple are 62 years old, and I'm first going to show someone that is comfortable with using a bronze plan with ACA insurance. And I'm going to show two different income numbers and how this affects their cost, at least on a bronze plan. And first what we'll see, and again, keep in mind we're underneath the subsidy slope right now. If this couple shows a reported income of $40,000, it might be difficult to see on the screen, but they're going to be eligible for a subsidy of about $2,800. Now, because the bronze plan that we're looking at has a cost of about $2,400 per month, obviously that subsidy being over that given cost, they will have a $0 per month monthly premium. But interestingly enough, because of how the subsidy slope plays out and how that subsidy phases out, if they showed $70,000 worth of income, they'd actually see they'd have the exact same cost for this specific bronze plan. The difference here, however, is now rather than having about a $2,800 subsidy, they have about a $2,400 subsidy. Now, because this bronze plan's cost is just underneath $2,400, they would still have a full subsidy and thus have $0 per month healthcare costs, even if they showed a little bit higher income. And so this is an important point to drive home. Depending on the plan that you end up going on, it will control how much income you can show because of that subsidy and the cost of the plan. Even after phasing out some of that subsidy, if it's still more than the plan cost, well then obviously you might want to show a little bit more income in the form of things like Roth conversions, because again, we're still talking at fairly low tax brackets, and you'll see other benefits within your tax situation by showing that higher income. Now let's use the exact same example, but now let's show a gold plan rather than a bronze plan. Now with this couple reporting a lower income of $40,000, what you'll see right now is this gold plan is completely cost-free. Once again, this is because the subsidy this couple is earning is more than the cost of the plan. So again, if this couple was only going to show $40,000 worth of income, they'd probably want to go on a gold plan rather than a bronze plan because they'd have that extra health sharing if they did incur any costs. Let's flip over to showing this couple at a higher amount of income, $70,000 per year. Well, at this point, they would start to see that subsidy start to fade out. And now that gold plan would cost $341 per month. And so this can be translated and should be translated into a tax cost. This couple shows an extra $30,000 of reported income, but they haven't added $4,000 in health insurance premiums for showing that higher income. So translate that to a tax rate and assess whether it makes sense to show that extra income. Now, when we talk about building a forward-looking tax plan for retirees, optimizing your situation around ACA insurance can be one of the most important things a pre-65-year-old retiree should be doing. And the reason being, as you can see, is because the costs associated with healthcare can be so large, and therefore the savings to your plan by showing a lower income level can be quite large as well. Now on the screen I have a tax graph for what it looks like for somebody that is on ACA insurance. Now this tax graph is shown with this person having $20,000 of taxable pension. But as you can see from here, in the blue we have the normal ordinary tax brackets, the 10, 12, 22, and 24% tax bracket. But now as we overlay the cost of phasing out that given ACA subsidy, we can see that your tax liability ends up spiking. And all we're doing here is we're translating the loss of a subsidy into a given tax rate and trying to assess whether it makes sense to show more income or whether it makes sense to artificially report a lower income. The important point for you is figuring out what that break-even point is for how much income you actually want to show. Now, a common question I often receive is how can I show a high income, maybe above 6 figures early in retirement, but artificially show a lower reported income and thus earn a larger ACA subsidy? What you want to do is you want to take a minimum level of IRA withdrawals. Let's say we're trying to show a reported income of $40,000, for example. Well, you might want to take the first $30,000 from your IRAs. This will fill up the standard deduction, making those IRA withdrawals tax-free. And then you'll only see the last part of those IRA withdrawals taxed at 10%. We'd be very comfortable paying those rates in most situations. From there, you'd want to lean on your taxable account because these are only counted fractionally. Only the amount of capital gains that you incur by taking income from that account will be counted against you. And so let's say that we have a $100,000 taxable account and 75% of that account is cost basis. Well, we can take $10,000 in capital gains, but that will really allow us to take about $40,000 in overall income from that account because only the portion of that income that is counted as capital gains will be counted against you. From there, you'd want to take as much from Roth assets as you need to fill up the rest of your income. Roth assets aren't counted at all against you in terms of that reported income. So this is a perfect example why a retirement plan built with the right strategies is so important. We can take one of the largest concerns that a pre-65 retiree has and largely eliminate that concern completely. Now, if you're looking for more ways to unlock hidden value within your retirement plan, click on this video right here, where we talk through a simple framework to show what is the first account you generally want to pull from in retirement. Thanks for watching, and always remember, you don't need more money, you need a better plan.